Good to have you. Nice to see you here at Post 9.
Thank you.
So, but when we were in the makeup chair a few moments ago, you were trying to tell me that utilities are a sexier bet than big cap tech right now.
Well, I'm not sure I'd compare utilities to big cap tech, but I would make the point that I think utilities are this underappreciated play on electrification. Electric is the future, related to vehicles and other clean forms of energy. The utilities are the big player here. And if you believe that natural gas prices are going to stay high, I think natural gas is the critical commodity for this decade. High natural gas prices, electrification, inflation protection, I think utilities are a good gift to equity investors.
It also sort of speaks to your broader view, David, which is that you're not chasing the rally. You don't necessarily
I wouldn't chase the rally. This rally has been faster and earlier than we expected. 4,300 is a big number on the S&P 500, not held today. Of course, it's a market of stocks, but 4,300, I think, doesn't acknowledge the continued slowdown, the likely decline in sequential earnings ahead for the next few quarters, whether we have a recession or not. And I think we'll have a small one. And the Fed, nevertheless, we think will still keep hiking through this year, possibly early next year, too.
The resilience, Mike, of the market, even in these last 2 days where we started weak both days and then sort of climbed, even in the face of bad news on the economy, mixed news on earnings. David said they've constantly been expecting downgrades. What do you make of the strength?
In the absolute keep it simple mode, it shows you that people just became way too defensive at the lows and really discounted the possibility that we could have a higher probability of a soft landing. And so once it started to seem like at least that was a greater chance that we don't necessarily descend right into recession and earnings don't fall apart quickly, people were underinvested. And the market behaves as if large investors felt they need to ramp their equity holdings back up from very low levels. If you look at the B of A Global Fund Manager Survey today, it says exactly that. If you look at hedge fund positioning, it tells you that. Now, we've adjusted to some degree. I think maybe things are looking a little more neutral. Just an hour ago, it looked like there was a little bit of a chase going on, people getting aggressive, the meme stock starting to run. All these reasons to say, yeah, sure, we should give back or flatten out a little bit. But as I said before, I'm not really willing to dismiss the idea that the market off the lows has looked a lot like really good rallies of the past that marked short-term or even intermediate-term bottoms.
But you're not going there.
I'm not. The flows and the positioning will follow the fundamentals. The fundamentals are still tough yet ahead. And the thing about corrections is that they tend to come in bunches. They love company. You can go for 5 years without a 10% plus pullback in the S&P, and then all of a sudden within a year, year and a half, you get 2 or 3 of them. Well, we had a bear market. I think we're done with that. But I don't think we're done with the corrections. I think we'll see another one in the autumn. In the meantime, utilities, healthcare, and for those that want the cyclical risk, my preferred is banks.
But what banks? Why banks? Because now we're looking at lower yields.
I'm expecting short-term yields, the Fed funds rate, to keep climbing. And I do believe we'll have a soft landing in the labor market, not necessarily for the economy or profits, but with a soft landing in the labor market, credit costs are unlikely to surge. Higher short-term rates, benign credit costs, very good for the banks.